before I got punched in the face and lost everything, of course, in 2006, right when I quit my CPA firm job and took a massive hit at that time. Since then, we flipped a little bit over 1,000 houses. We have over 35 million lent out to flippers in different markets around the country. We do a lot of value add multifamilies, syndications on the GP side, as well as invest passively in a bunch of different syndications on the LP side as well, and help a lot of clients kind of create that financial freedom in their life and help them with the tax mitigation strategies and cost segregation strategies. I also have a CFO services and bookkeeping company. I have a 6-month course that I teach on real estate investing. And then we have a nonprofit that we teach financial education and real estate education based here in Southern California that we've been running since around 2008. And just to teach all different types of strategies with related to real estate. So I really love this stuff. My wife won't let me talk about it, so I'm excited to do podcasts because she says, honey, I really like what you do, but for some reason I fall asleep every single time, so, but, it's great to, be able to talk with like-minded people and be able to, talk shop and kind of share what I see out there in the market.
All right. This is probably a question for later, and I'm not sure if everybody will want to hear about it, but I'd love to hear how you balance running a CPA firm and doing your other real estate activities. That actually sounds really interesting. But let's start off with what your background is in terms of what was your first investment property, and how did that go? What did it get you into, and how did you move through your investment growth?
So I started off, I was working at my CPA firm, going crazy, I can't do taxes and audit. This is the most boring stuff on the planet. It's just not my personality. And I went and wanted to invest in real estate, and I ended up getting my first fix and flip deal after buying a rental property that I bought up in Cheney, Washington. There was negative cash flow by $500 a month. And I'm just thinking in my head, oh, I need to make, if I buy it, okay, I can float that 500 until it becomes positive cash flow. Doing everything wrong. Had the worst property manager, of course. Had no idea what snow was, of course, living in Southern California beforehand and realizing the trials and tribulations you go through when you buy property where there's weather, right? And did everything wrong in the very beginning, just not knowing, I got to get in. I don't know how to do this yet. And didn't know how to do my math or anything else. And there was a builder up there that was building, brand new houses that we could rent out. And I pre-bought it, of course, and at the worst time of the market to be able to buy a property. And so that was my very first deal. And then I went and I got my first fix and flip deal under contract out in Memphis, Tennessee. I did an analysis on a lot of different markets around the country to determine what the highest cash flow markets were, because I was trying to counterbalance that negative $500 a month in cash flow. And I got my first deal under contract and I just quit. I was like, I'm done. I can't do audit anymore. I'm going to bang my head against the computer. This is the worst stuff on the planet. And then jumped ship and started my flipping experience. And ever since then, of course, I quit my job and thought, oh, now I'm going to have plenty of time to go to the gym and do all kinds of other stuff and everything. And it couldn't be the furthest from the truth. I look back at working 40 hours or 50 hours at a CPA firm going, I remember my first part-time job, of course, back then. And now it's, I still work, quite a bit, mostly because I have all these different businesses and am interested in growing, more focused on my education and relationship development and doing new types of deals. My brother that works with me, he's my business partner. He calls me the deal junkie because I love doing this stuff. I find a new opportunity or shiny penny sometimes and I go after it. So, and to speak on the CPA thing, it's all about delegation, right? And having the right team that can do these things and set it up. Me being a CPA myself, I understand what the needs are for a lot of people, which is primarily don't pay taxes and find ways of not paying taxes. Whether you're a W-2 person or self-employed, there's tons of strategies out there to literally pay no taxes. I went through and last year I bought property and different investments and I got a $605,000 tax deduction in 1 year just by investing in real estate in different ways. So there's some really cool stuff out there. And so a lot of people come to me for that need. And I have an outside CPA firm and bookkeeping company that I work with that I've made strategic partnerships with to be able to help my clients out and be able to bring that in-house because there was such a big need. You know, for example, in my fix and flip company or my lending company, for example, one of the biggest things that flippers have a problem with is cash flow management and budget versus actual on their projects and things like that. And you realize very quickly that that will make or break you in this business, right? They're going out and trying to get as many flips as they can, and then they run out of capital because they don't have enough capital sources, or they have too many capital sources and not enough deals, and they're constantly juggling one or the other, and they end up not having the right cash flow management, not realizing that they're way over budget on projects. And that's where the bookkeeping and CFO services kind of company came in, because there was such a need. And I'm going, how do I mitigate risk for, I'd say, less sophisticated borrowers on the fix and flip side versus, I'd say, multifamily or syndications that have a little bit higher levels of sophistication when they're investing in those types of opportunities, and mitigate my own risk as well as help business owners out, because there's such a big need. My wife is a QuickBooks Pro advisor, and I don't want her to do the work, because there's no way I could go tell her, where's my books right now? I need it right now. It just wasn't going to happen. So I had to bring that in for myself and my own business, as well as outside people that really needed that help, because it's one of the biggest crutches that people have in real estate is nobody teaches the financial education side, right? How to set a personal budget and a business budget up, and budgets for your individual projects in detail, and the right financial plan there. They start, using their own personal money for their projects, and then not having money to live, right? And getting themselves in a real bad spot. And so that's why we started that company in the first place. So
I want to hit on two different things here that I hope will be useful to the group here. And the first thing is that I completely agree with you. Getting a little bit of financial education around accounting is actually really key to this business. I started looking at a couple of accounting books here that were more recently published, and I ended up just not going with that. I went back to my mother, who is an accounting major, and I grabbed her old college textbooks, which were from the 60s, and they were thick and extremely detailed, and they were the best textbooks ever on the topic. And I'm sure, some things have changed, but setting up a chart of accounts and tracking transaction types and different types of ledgers, that hasn't changed. And just getting a little bit of knowledge about, what the difference between expenses are and capital expenditures, or how do you track assets and liabilities and what makes them different than income and revenue, and just keeping all of those accounts separate. Just getting a little bit of education in there will really, really help you with being in real estate. And I'm self-taught too, just by reading my mom's college textbooks. My CPA is okay with that. I took his template and I implemented it in my own spreadsheet, and I can generate his reports, and so he's happy with it.
My dad was a CPA also, and had me doing checkbooks when I was like 10 years old, which was great. I think it's really important to understand that side of things when it comes to investing in passive syndications too, because how do you know how to do the right due diligence on your operators? And if they have that set up right, if you don't know what the right way to do it is from the start. And so, that's one risk that I look at greatly, because that I see a lot of people faltering on. And so being able to dive in deep on who's their accounting team, who do they have on their team in detail, what's the financial reporting, does their financial model make sense in the first place? All those things are crazy important from an accounting perspective. It's almost an unfair advantage on, having that skill set in this business, in the real estate business. So.
Now, we've actually had a couple of people in our discussion, which we have a Yammer group internal to Intel. Almost nobody uses it. I'm hoping people will go to the Facebook group and use that one, but we shall see. But one of the questions that came up today was we have a guy who is looking for a good tax accountant to do his taxes. He's got a couple of syndications. How would you suggest we go about finding a person or a tax accountant who's familiar with syndications? What would be your tips for doing that?
So definitely finding someone who's focused in real estate is key. And at the end of the day, CPAs are horrible communicators. They're really bad at this. And so you have to sometimes increase your own knowledge base so that way you know enough to know what questions to be asking these different CPAs. And having the right CPA that not only teaches you about your own situation, but will actually do the planning for you on a consistent basis and has done syndications in the past, knows how to do special allocations, for example, for depreciation inside of a syndication, or knows how to do the right reporting for you that can help prep that stuff for you too, and take it to that next level is really, really key. There's a lot of good CPAs out there still that will understand the basics of real estate taxation and things like that, but they may not take it to that next level on cost segregation studies or 1031 exchanges or a number of different things that can come out of that. And when it comes to the syndication space specifically, of course, it comes down to like the reporting. Can they help you get that stuff lined up? Can they review your bookkeeper's books to know that those books are right before sending it out to all the operators? Because there can be some real expensive bookkeepers out there, and they're horrible, right? And you still don't know that they're horrible if you don't have that knowledge base. So having that other CPA out there that will do that review for you on top of the bookkeeper and having that proper segregation of duties, I think is key. And then making sure they do proper tax planning for you. So they sit down with you every single quarter, go over any changes that are occurring. And you may not need it every quarter, but looking at it at least maybe in the first quarter of the year, the last quarter of the year, so you can stick and move and do your changes to not pay taxes before year end, I think is really key. But knowing what questions to ask, how many other clients do they have? Do they have experience in syndications? Anytime I have a new team member, I have a list of questions that I ask any new team member that I'm, working with. And I think that's really important to go out and come up with the list before you go to any attorney, any CPA, any lender, any, closing agent or realtor or, a contractor, right? Property manager. All those people are very important to your business. And if you don't have any of those, if those are not lined up correctly and are the wrong team member, any of those can, put you dead in the water before you even start. If you don't, you're only as strong as your team. So understanding the right questions to ask, having pre-questions that you're going to go through almost like an interview before you pick somebody. And I would say, just like you would a contractor where you're going to get 3 bids, go out and interview 3 different CPAs. Go get referrals from other people in the syndication space that people they use, and interview those people as well. All those things are great tools to mitigate the risk of getting somebody that just doesn't have the time for you, doesn't answer your questions when you need, 1 or 2 questions asked on a monthly basis or something like that. That's key too, is are they going to be available for you to be able to do that? And that comes with any team member, right? So you're always going to have ongoing questions. You don't want to have to wait a month for them to get back to you, or a week or more for them to get back to you on specific questions that you really need answers to.
Yeah, a couple of thoughts. Good CPAs are really busy, and so sometimes it really is difficult to find the right trade-off between a knowledgeable person and a person who has time to respond.
Right.
I was going to recommend one of our previous speakers in this club was Amanda Hahn, back in was it March of 2020, I think. But she is with Keystone CPA. I know she's a really good CPA, and I've also heard from people that she's fairly full, or her client list is fairly full.
Yep.
But she's a good one to look at. I use Mark Perlberg. He deals a lot more with like single family homes, short-term rentals, and he's hitting some growing pains with some of my syndication work. But he's a good CPA too, and he responds a lot very quickly, which I like.
I really like Amanda too. I've interviewed her for my real estate course and things like
good.
that. And I've been working with her for years and doing presentations with her for years as well. I highly recommend her. But yeah, her client list, she does a lot of great marketing. So she's got a big client list, and but she specializes in real estate specifically, which is really what you're looking for in this space.
And then there's the Real Estate CPA guys. They have a podcast that I like listening to. It's a really good podcast. And I don't know anybody I know a lot of people do use them, but I haven't had conversations. I assume they're good at what they do. So there's that. Matthew, you mentioned tax savings and that you got a lot of tax savings. And this group is, of course, we're all W-2 employees. We have full-time jobs. We're busy people. Most of the people on this call are not looking to go fix and flip, right? That's time intensive.
Right.
Some are, maybe some love it. And also thank you to all of you who are putting comments in the chat room. I see those questions and we're going to get to them. But I wanted to ask you, can you give us just a couple, maybe 3 tips that a W-2 employee can use to lower their taxes using real estate?
So
Or
I
what are
think,
your top tips?
yeah, absolutely. So I think the very first thing is every single year you should be buying property and doing cost segregation studies on those properties. And a lot of the syndications that you invest in, they're fully focused on cost segregation studies. Now this year in 2023, it dropped down a little bit with regard to, it's like 80% bonus depreciation instead of 100. However, and a lot of times the W-2 people that have W-2s have a hard time utilizing all of those cost segregations and all the depreciation benefits. So what I recommend is you invest in some types of property like that, where you get these big deductions, but also invest in different interest income and other rental income properties, because it's all a matter of the passive loss rules, right? Where you're able to go through and take those cost segregation studies against your rental income from the actual investment you put your money into, any other rental income first as well, and then also any other passive income like interest income and things like that. So investing in promissory notes or things of that structure can allow you to then take some of that additional depreciation against that. And then of course you can claim, I believe it's up to around 25,000 on additional deductions against your ordinary income. And if you're to do that every single year, now if you make too much money, that gets phased out, of course, but you get to carry it over into future years. So those are some of the strategies that I really use every single year, because I'm a full-time real estate investor and I can take full advantage of it. But for the W-2 worker, it's a little bit limited on that side. I would suggest even starting a side business as well. There's no reason why everyone here shouldn't have some sort of side business to turn some of those personal expenses into business expenses and write some of those things off, right? So you should be able to make some other active income and be able to turn some of those other personal expenses into business expenses. In addition to that, I don't know how many people are fully aware of being able to roll their retirement vehicles from a previous 401k into a self-directed 401k. I have my own self-directed 401k, my own self-directed IRA. I have also my own self-directed health savings account. So where I go and invest all of these things directly into real estate, I can actually control these things too. And you have to be careful about some specific taxes. You can't be running a business inside any of these things, because there's what's called an unrelated business income tax that you could be, taxed for by running a business inside of it. But you can just take your old retirement accounts from your old companies and roll those right into a self-directed account. And now you have control over the direction of those investments, to invest in different syndications, to direct and direct property ownership, to invest in promissory notes, or pretty much anything except for life insurance and collectibles. And now what's more important about that than just investing that is now you are in control of your investments. You're not just saying, hey, Fidelity, Schwab, that's going to take 60% plus of your gains via trades and fee structures and things like that. Go and invest it in the risky or non-risky investments. You're able to go through and control and learn how to invest your own money, which gives you a lot more power to be able to invest in the alternative assets that you really, really want to invest in. If you're working with a company right now, typically they're not going to allow you to do what's called an in-service transfer and transfer that while you work there, your 401k into another self-directed 401k. You'd have to look at the plan documents to determine if you can or can't do that. 99% of them don't allow you to do that because they want to control your funds while you work there and keep those invested. But the cost seg studies are literally number one. Starting your own business on the side and doing those types of things is definitely a big one. Being able to max out your 401k contributions and self-direct those things, as well as your health savings accounts and your IRAs, and self-directing those things are really, really key for, I think, long-term wealth building and being able to mitigate taxes long-term. So those are some of the key strategies that I focus on. And every single year I'm getting $500,000 tax deductions. And it's like last year, for example, I put in one investment for $100,000 into one multifamily deal. And because of the leverage on that multifamily deal, I got a $100,000 tax deduction. That's literally a 30% return on my money just in tax savings alone, on top of the preferred returns and the investments that I'm making there and the actual cash flow of the deal in itself. And that's just year one, which actually mitigates risk a lot, right? Because if you're now in it for $70,000 instead of $100,000 because you just got a big chunk of tax savings in year one, that can be absolutely huge, right? And you can invest in direct real estate too, without having to do the work. And you can actually be passive on that side if you have an asset manager in place. As you become business owners and you start to see some of these things, you're able to go through and hire the right people to manage projects like short-term rentals. If you want to get involved in that type of strategy, I would highly recommend you never do that yourself. I used to do it myself for a while, and it just is a nightmare to deal with. And I would say hire a manager, but also hire an asset manager on top of them to be able to manage those managers. Even if you're owning direct real estate, sometimes it's easier to hire that asset manager in place to manage those projects, so it takes some of that workload off. Because we all got busy lives, right? We want to go through and, spend time with the kids. I'm coaching 2 basketball teams now for my son by accident almost. So I signed up for one and I was worried I wasn't going to make it. So I signed up for another one and they both wanted me to coach. So I'm coaching 2 teams now. So, but those are some of the main things that I would focus on.
All right. We're going to get to the questions now. So I'm going to go down the list here. Actually, I want to add one thing maybe for discussion with the short-term rentals that you just mentioned with hiring the managers. And that is that a lot of the passive activity loss rules for people, you're a real estate professional, right? So you're going to get those deductions, as a real estate professional. But a lot of the people here aren't real estate professionals. And as this group knows, in order to be a real estate professional, you have to work at least 750 hours on your real estate projects. And it has to be the job which you spend the most hours at over the course of a year. So most Intel people are not going to get there. And you'd be crazy to try. But maybe your spouse could, and that actually would help you. So what I was going to say, for people that are not real estate professionals, if you do spend time on your short-term rental, managing it yourself, maybe in your first year and setting it up, and this was advice that was given to me by Mark Perlberg, my CPA. If you spend more than 100 hours on the project over the course of a year, more time than anybody else, or you spend a total of 500 hours, even if there are people that are spending more time on it, like a manager or a cleaner or someone like that, then you can qualify for, those are 2 of the 7 qualifications in the passive activity loss rules. And what was actually recommended to me is, hey, take a little bit of time, qualify for those passive loss rules. That'll let you take a huge tax deduction. And then once the property is kind of off and going, give it to a manager that can run the property thereafter. Now, of course, that depends on whether you have the time to do that or not. But I did a cost segregation on our short-term rental, and I actually am in the process of doing my taxes right now. So I don't know exactly what the deduction is, but it will probably be fairly large. I believe the amount of deducted interest I got, it was a $675,000 purchase, and the amount of that the cost segregation came back that I could rapidly depreciate, I believe, was $161,000. So if you qualify for those passive loss rules, it can be a huge tax savings, or maybe even offset all your taxes. So that's something to think about.
I think there's a huge benefit as well by, that's great for being able to deduct those big chunks. Also realizing that short-term rentals cash flow a little bit better most of the time, depending on how you buy and who your manager is and where. Of course, be very careful about where and that management, if they know how to do the right marketing for your short-term rentals and things like that. But at the end of the day, you can create it a lot more passively, where you have the manager, you have the asset manager in place doing that work for you. So you are 100% hands off. And now that's passive income that can be offset against that big cost segregation, and then that cost segregation study can flow forward to future years as well against that other rental income. So it's a great way to utilize that additional rental income too, for passive losses or passive income against the other losses over here. So but yeah, I mean, if you're active, of course, having your spouse be active is one of the best ways to be able to, if you have a full-time high earning job over here and your spouse isn't working or something, and you want them to focus on real estate, getting them to that 750 hours or getting them to be the full-time real estate investor status and their primary income stream, you can really take advantage of that. And now you can take it against your active income, which is, it can be gigantic for tax savings.
All right, let's hit a couple of the questions that we have here and continue to put those questions in there. We're going to try and get to them. And then towards the end, Matthew, I also want to give you a little bit more time just to say what your major activities are now, and how people here can interact with you.
Absolutely.
So first of all, we have Samuel Russ, who's asking, he wants to use Intel stock for real estate investments. And before you answer that, Matt, I want to point out we had John Tapley, who actually helped run the Apple Real Estate Club and is now over at Amazon. But he spoke on going to a brokerage account and then using your RSUs as collateral for creating a margin account, and then using that margin account to invest in real estate, which was a really interesting strategy. He's got a whole talk on it. So check that out. I think he talked mid last year. Oh, here he is. September 3rd, 2021.
So I think, from my perspective, obviously utilizing leverage like that can be interesting. I think being careful, of course, with the amount of leverage that you utilize is super important. You don't know if real estate's going to go up or down, or your stock is going to go up and down, and you have a margin call or something like that. Real estate is an illiquid investment for the most part, right? It can be difficult to get your funds out or take months to get your funds out. And so you have to be very careful and have I think a lower leverage if you're going to go and leverage your stock to do that. I wouldn't necessarily personally be comfortable doing that, just because of where I see the overall market going with regard to the economy as a whole. And I'd be concerned with those margin calls and things like that. Now, Intel, I don't know a lot about their specific stock and their earnings price ratios and things like that to be able to tell if it's valued correctly, right? We had a big bubble in a lot of stocks in different areas. So I think just being careful on that side and having a low leverage, if you are going to go that route, would be a smart move to utilize that if you are going to do that. And obviously being careful, because you don't want to go sell it and then create this big capital gain for yourself just to invest in real estate. But if you do have that capital gain, maybe you can buy real estate and do a cost segregation study or something like that to kind of counterbalance some of those gains over there. So I just would be really careful, just because you're using leverage, right? And if you're already going to use leverage for your real estate in the first place that you purchase, and you're using that for down payment money, that technically means you're 100% leveraged on that real estate, right? And so making sure that you still cash flow very well, and you have an exit strategy where if you had to pay back that stock loan or that leveraged position, that you're able to do that relatively quickly and easily, and have a backup plan to be able to pay that off, so that way you're mitigating risk.
Let me just thank you for all those words of warning. Let me just say in there too, in this club, I am not recommending any real estate strategies. I am an academic in a certain sense that I geek out on hearing other people's strategies and understanding them, and just increasing my own ability to in my own financial education. And that's what I'd recommend. When I was recommending that talk, it's interesting from learning a new strategy point of view. But I agree with you. It is a high leverage, and you need to understand the risk of what you're getting into. So that is not a recommendation. Just go check that out if you want to learn more. There are other things which I'm not recommending, like opportunity zones. Matthew might be able to talk about that a little. I'm not sure.
The biggest thing about opportunity zones is they can give you great tax benefits in different ways. But I found like opportunity zones, like DSTs, those types of strategies that are primarily for tax mitigation, usually have a little bit lower returns than I see in other real estate investments because of the tax benefits. You're not necessarily getting any better return in a DST or an opportunity zone because usually the cash flows are a little lower and other things because people are tax focused in those opportunities. So all the ones that I've seen haven't really made sense because I think those investments should stand alone with regard to your cash flow and other attributes to that investment and risk mitigation of that investment in itself versus just focus on the tax. No investment, in my opinion, you should be going into just for the tax benefits alone. So I think it should be standing on its own and being careful on that with DSTs or opportunity zones and knowing what you're getting into. Understanding the operator and the different team involved is absolutely key. None of the tax benefits should trump the overall metrics of the investment in itself.
Yeah, I would agree with that. From the point of view of a person who is on the purchasing side or the operating side of multifamily properties, I've seen usually opportunity zone properties that are in opportunity zones tend to get bid up higher, and oftentimes people will pay more than they can make a good business plan work at, and they'll justify it saying, "Hey, our investors are getting great tax benefits." And opportunity zone properties do tend to get bid up a little bit more. Although I have seen ones that as standalone, without the tax benefits, they have a good business plan. So they're out there. But as a general rule, yeah, I think you're right. They do tend to get bid up more. All right, Beth is asking, has the topic of evaluating HOAs before purchase or during holding in terms of property management or issuing assessments for large community repairs been addressed? I'll grab that really quickly. I think that's a great topic for our next discussion group because every single HOA is different. They all have different rules. Every locality is different. That would be a great topic just to bring the wisdom of the crowds to. So I would be thinking about it. If you have an HOA story that you want to tell in a couple of weeks, whenever we have a slot that hasn't been taken by a speaker, we'll do a discussion group. We're trying to do one a month.
And I think you should be very careful too when you buy properties with HOAs, especially for rentals. Remember, the HOA community and the people that are running these things, running the HOA, they're just regular everyday folks, right? So and part of the community. So sometimes nobody wants to do that has any real financial wherewithal. And then you end up with someone that doesn't know what they're doing. They run the budget into the ground. Then you have some massive reassessment or some problem there. And so being very careful and doing your homework on the HOA and who's running it right now is very important from a return on investment standpoint and a headache perspective. Sometimes they make up rules like you can't sell your property to another investor. It has to be a homeowner or, random stuff like that you want to be really very careful and look at those HOA documents. We've taken hits on those types of things in the past in our rentals where you just realize, oh man, we got this crazy person running the HOA. Be careful.
Yeah, read those covenants and restriction documents.
Yeah.
Let's see, Henry is asking about the debt ceiling impact and the overall market opportunities for good investments. I don't know if macroeconomics is your thing, Matthew, or not, but do you have any thoughts on the debt ceilings or just the current economy?
I'll say I'm more of an anarchist and libertarian than anything else mentally, not to talk about politics, but I believe all that's hoopla, right? They're gonna increase the debt ceiling. They're not gonna go and stop it. They never have before. They're gonna go and pretend like it's gonna be a problem and then raise the ceiling again, right? And then as far as opportunities go, I think the multifamily distress that we're gonna see in the near future because people were buying at inverted rates where cap rates where maybe they're buying at a 5 cap and the rates are 5.5 or something like that for the loan rates. That's going to really bite a lot of people on their value add strategies and on their refinances and not be able to refinance and create a lot of distress. I know a lot of VC funds and different people that I work with right now that are they're in their full vulture mode right now going, let's find these multifamily operators that are in trouble. And so that I think is one key thing. I also think subject to deals where people bought property or single family homes or different assets in 2019 through 2022 and they were buying wrong, where now they're going to go through and try to sell these properties, and after realty fees, closing costs, maybe some repairs, they're going to be break even at best, and they can't get out of their property, for example. You have an opportunity to come in and buy a property subject to the existing financing and leaving that in place. Now, there's specific structuring rules. You got to get the right advice there, be able to buy those things correct, because there's a due on sale clause in all of these loan agreements that says if that seller sells the beneficial interest of that property to somebody else, the lender has the right to call that loan due. So you have to buy it correctly inside usually a trust or something along those lines, but getting the right advice on that is key. But there's a great way to be able to come in with very minor down payments, make rental arbitrages, especially if it's in a key short-term rental area that might cash flow even better in a short-term rental, or just make a smaller arbitrage on a long-term rental where you could take advantage of people's 3% interest rates that now they can't get out of it. Maybe they lost their job or they need to move for some reason and they're going, great, I'm going to be underwater. I don't even have moving costs to leave this thing. And so that's a massive strategy I think is going to be huge for the next few years as we see some faltering in the economy and some shaking out of people's situations, right? There's going to be distress, in my opinion, coming up in the near future, and already seeing some signs of that. You're seeing defaulted auto loans and stuff like that coming up. People's now savings went from an all-time high in COVID situation when people were getting massive bailout money. Now they're very, very low on their savings again, where their savings are getting depleted. Their credit card debt is much higher and in a high position. So just being really careful with the overall economy, I think, is important. But the subject to deals along with multifamily, and that distressed multifamily, I think, are two big opportunities that are going to be coming up in the next couple of years that I think is going to be just massive, and two things I'm actually focused on quite a bit with our portfolios.
All right, Matthew, we're going to try and hit a bunch of questions here. And Beth has a great one here. If you had a choice for your first investment purchase between a single family home long-term rental and a beachfront condo short-term rental, which would you choose and why?
So I think it depends on the math, right? And it depends on the city and the risk, right? Some cities, for example, we used to run some in Orange County very close to Disneyland that was just killing it for us. And the city said, oh, we're going to pretend like that was illegal all along. So now you can't do that anymore, right? And then you either have to shift your investment. So making sure you're investing in a city that has already made their rulings and it's all working with the occupancy, and you really should be putting a 25% plus vacancy factor on your short-term rentals as well. But I like both methods. I think it's a proper way to diversify both. I also want to look at what the math tells you with regard to your down payment requirements on that beachfront property or the other properties involved, in making sure that it's good long-term investment, the demographics work in those areas and things like that. So I hate to not give you the attorney answer of it depends, right? But it really does depend on the math on each one of those and the workload involved, right? What happens if the economy goes down and now you have a short-term rental that you had one projected occupancy rate and now you have a different occupancy rate because less people are traveling to that really expensive vacation home, right? They might say, no, I don't need to be right on the beach anymore, right? Now, don't get me wrong, there's always going to be demand in a beachfront home, right? Comparatively to other properties. And so looking at the demographics and what's coming into the area, every single city is different. So, like for example, in Florida, they're not seeing major volatility in values and rental prices and things like that, like they might in, a Southern California area or other markets that might be more volatile, for example. So understanding where it's at and the math behind it and making sure you're doing your math right is key. And if you guys want to go to my YouTube channel, I do a great video on short-term rentals and how to break down the math. It's at OCG Masters of Real Estate is the handle for my YouTube channel. And you guys can find the short-term rental breakdown that I break down the math of that so you guys can understand the right math, because everybody does the math wrong like half the time on these things. And you also got to consider the additional costs of all the furniture and the upkeep of that type of asset as well versus the other asset that you're considering.
All right. Next question is from Christina. On a new LLC, and I guess I'll preface this with, I know you're not a lawyer. She's asking, on a new LLC, I would like to know the best IRS entity classification election for a long-term single member LLC. How to transfer the property to the LLC. I have some thoughts that I've done on my own. I'll let you answer, Matthew, or if you want, you could just say, speak to your attorney.
Yeah. So look, speak to your attorney, but my attorney gave me this advice, which is basically, look, rental properties, you want to hold long-term rental properties, you want to hold in an LLC. I would hold all rental properties in an LLC. If it's active income, then normally you're going to be looking at an S corporation or an LLC taxed as an S corporation. If it's a rental income or it's passive income, then you're going to want to hold it into a single member LLC. Usually, if you're getting, and it depends on the lending too, right? There's lenders out there like we do what's called debt service coverage ratio loans, where you can get loans right to your LLC directly. And then there's other loans that are done through Fannie Mae, Freddie Mac, which are usually done to you based off of your income, versus the debt service coverage ratio loans, which are based off of the rental income, and they qualify you based on that, and they don't care about your personal income. And so looking at, is Fannie Mae, Freddie Mac going to be okay with you deeding it to your single member LLC? Usually they're okay with you doing that because you're technically not transferring the beneficial interest of that asset. You still have 100% ownership of that LLC. Now, if you transfer to an LLC that is owned by two people now, but you got the loan in your name, now you just transferred a portion of the beneficial interest. And so they may not look at that favorably in that case, and they may call your loan due if they wanted to. Normally, they're not going to call your loan due if you are still making payments, unless you got a crazy low interest rate and the bank's going, hey, I want that one paid off, and they kept it on their internal portfolio versus selling it off to Wall Street at a million pieces and they don't care anymore. But this is just hypothetical, right? This is what I've seen over a period of time. You definitely should get the right advice because each situation is definitely different, but I would absolutely go through, and normally I hold all my rentals inside, LLCs or a partnership style LLC with my brother, or different business partners and things like that. If it's my solely owned property, then I hold it in an LLC as well. I think I answered the question,
Okay.
but I'm not sure.
Feel free to take yourself off mute and talk if you want to, ask a follow-up. All right. So I'm going to skip around a little bit because I think we touched on some of the questions already.
I had one follow-up question for Matthew on the LLCs.
Yeah.
If you're doing one per property, Matthew, are you setting those up yourself, or do you use a service to set them up?
So this is a tricky question because normally if you have your own ownership of that asset, it's not going to be the most important thing when you go out to an attorney to do it. Is if you have partners involved, then it's important to go out to an attorney and get that right advice with regard to the operating agreement. You can always go to a service and it's quick and easy to go do that, like a LegalZoom or something like that. If you are your own entity, if you have your own entity and it's a solely owned LLC in that situation, but having the right operating agreement whenever you have partners involved is key. And I personally don't keep all of like an LLC on a per property basis. And the reason I do that is because I'm comfortable with the amount of equity that I'm trying to protect. So if you have $250,000 of equity or $500,000 in equity in one property and another 500 in another, and you want to protect them from each other. So a tenant sues you on one property and you have this multiple properties in one LLC, then they could go after your other properties, right? And that's the risk that most attorneys are trying to mitigate for you with regard to saying set up all these entities, right? But I know people that own a ton of properties just in their own name, but they get a $2 million general liability policy and an umbrella policy over that to protect themselves. And it's a lot cheaper than setting up 5 LLCs that, come with $1,500 a year worth of, extra costs and a $2,000 tax return and all these other costs and bookkeeping for each one and all that other stuff, right? So it's a matter of what your personal comfort level is with regard to how much equity you're going to protect. Now, if you got 50 grand in equity in one house and 50 grand in another house, and you want to keep them in the same LLC, and you're comfortable with having an additional layer of a high value insurance policy on each one inside the LLC, like a $2 million policy on each, and potentially an umbrella over that instead, and keeping one entity. It's all based on your personal comfort level. But every attorney on the block is going to say, I can't go tell you to go create one LLC, because then if they do get sued, and you do get sued and they go after another property, guess what? You're going to be going after their general liability policy, that attorney's. And so really you need to look at your own comfort level as far as how much equity is in that property that you're trying to protect. And are you comfortable with your current insurance policies in place? And I would actually make sure you have like a AAA rated insurance policy, make sure your deductibles are in line, make sure that, if they do have a claim, that insurance company is going to pay, right? So those are the main things you should be considering when determining, should I set up an entity for each individual asset or combine them based on your own comfort level with regard to how much equity is in those individual assets. And then maybe you're comfortable with 500,000 of equity, and now you got another 500 over here, and you got 4 or 5 houses in one deal, one LLC with equity, and then you have another entity over here with another 500,000, and maybe you're comfortable with that, right? It depends on your own personal comfort level, but you have to understand the risk that you're taking, that a tenant slips and falls and sues you for $10 million, and they can come after your other assets inside that LLC. That's why it's important to have that umbrella policy in place on top of your general liability policy, if you can, right? So that's my answer. So sorry. So, and then, I think it's important from a liability protection standpoint as well to understand the type of income, like I was saying, and what risks outside of it exist. If you're running another business out here, having additional insurance like E&O policies and stuff like that in place, and getting the right advice from the right attorney as well as the right insurance agent is going to be key for your complete liability protection there. And like I said, I'm not an attorney. This is just what I've learned over time doing this.
Matthew, we've got less than 1 minute left.
Right.
So first of all, can you give us how and why should people reach out to you? How can we reach out to you, and what should we reach out to you for?
Invest at ocgproperties.com, or you can go to my YouTube channel and follow me, which you shared the link for. People can come to me because we do fix and flip loans. We do long-term loans. We have a 6-month real estate course on every aspect of investing. We help people invest in syndications and create that financial freedom in their life. So there's a number of ways we can help across the board. And we also have the tax mitigation services and bookkeeping services. So however I can help. And
I dropped what I think is your YouTube channel in the chat. You might want to verify that was actually the right one. At OCG Masters of Real Estate. That's okay. Correct. So I dropped the wrong link in. Is that correct? It was. I didn't see what it was, but it should have been at OCG Masters of Real Estate. Okay, I dropped the wrong link in. So I'll let everybody know that. And could everybody take themselves off of mute and thank Matthew for coming in and talking to us today?
Thank you.
Thanks a ton, Matthew.
Thank you.
Thank you, Matthew.
More guys.
Thank you.
Thank you, Matthew. It's been really good hearing all your insights into the real estate market. And we will be back next week with, I believe our topic is debt funds. So we'll see you all then. Bye.